Hi, great to see you. Thanks for attending my special market update. I know 2022 has been a rough year, highly volatile, and our clients have been great in doing the right thing, staying put. So congratulate yourself and staying invested in one of the toughest markets. But I'm looking forward to giving you some positive outlooks and things to look forward to for the rest of the year. So as we look at the market and what's to come, I think it can be summarized on 4 slides with some actual data. So looking at the S&P 500, the 500 largest stocks in the US economy, we've seen that over the years, even during difficult times of inflection, that the market has recovered in bull markets. We're sitting year to date with a negative 12% return. But looking at the bigger picture, we realize that markets always seem to find a way to find a new high. So in looking at the S&P 500 index, you can see the inflection points. We look at, March 24th, 2000 being the high point when the S&P reached 1527 after a 106% increase. And that was really the end of the tech boom, which many thought that the market would really never recover. As you can see, it was a short time period before the market regained another 101% until October 9th, 2007, where it reached a new high, and the market then retreated during the 2008 financial crisis. And after that, it was easy to think that the market, would not recover and be broken. But as we can see, we had a 401% increase from that point till 2020, at which time COVID-19 market valuations and uncertainty took over. And even at that, it was a short time, 1 month, before the market then increased 114% to a high of January 3rd, 2022. So from that high to now, we have seen a negative 24% decrease and then a rebound. So where we sit currently is 12% off the market high. And what we expect in the future, obviously, is the continued upward bound of the S&P 500. And as the saying goes, we don't want to just know the price of everything, but what its value is. So looking at S&P valuations, we can then determine if the current price is a fair price or we expect that price to increase in the future. So S&P 500 valuation measures, you can see that the 25-year average is 16.86 times earnings. And currently, as of August 10th, we're at 17.77. So just slightly above the 25-year average, but overall fairly valued. So in looking at annual returns, when we have years where we sit with a negative 12% or negative 24% decline, it's easy to ask, well, what's the likelihood that we end up with a positive 2022? Well, in fact, it's happened quite often. So in looking at annual returns and intra-year declines, you can see the red dots represent the worst point in that particular market year, and then the graph that shows the end of year return. So in looking at 2022, our worst point, we were down 24% in the S&P 500, and currently it's down 12%. The prior year, it was down 5%, but finished up at 27%. And then in 2020, the worst point, the market was down 34%, but finished positive 16%. So it's important to realize that just because the market is down doesn't necessarily reflect where the market will finish. I think one of the most powerful slides I'm about to show you is that during times where consumers are least confident is usually the time where the market has the best returns. And it's easy to have market volatility and uncertainty, and you talk to your friends and everybody's just really worried about the market. But let me show you some information that may make you feel differently and more confident about what's to come. So consumer confidence in the stock market, you can see the blue dots represent the points of consumer confidence. And at the lowest points, and in our recent history, all the way back, even less confident than all the way back to 1980, is where we sit today. So consumers are looking at it and not feeling good about the future of the market. However, we can see that it also represents times where the market has its greatest returns. For example, if we look at April of 2020, when consumer sentiment was low, it followed by a rebound of 43%. So currently, where we sit as of July 22 would indicate, if history repeats, a positive of 51%. So it's a great time to be invested in the market, even though it's probably the hardest time to be invested in the market. Thanks for joining me for my special market update. I hope that through looking at these 4 slides, you can see some positive possibilities for the rest of the year. But if there's one thing that I know, it's staying invested. Time in the market trumps all. So economic factors are complex, but staying invested, doing the right things, staying diversified, and controlling what you can control really works out for our clients. And so thanks for watching, and look forward to seeing you in the office soon.